Welcome to the UST Education recorded webinar series. This session is powered by US Transactions. UST is a boutique payment processing firm providing you with personalized service. We offer agnostic, best fit technology solutions for associations, nonprofits, and enterprise clients.
Great. Hi, everybody. I'm Michelle Barry, and I will be the primary facilitator today, talking about cash. It's all about the king. So I would love to learn from you in the chat what what your questions are, what you're looking to get out of it, and that way I can let you know how likely that is to be what happens today. Kenneth, I'm hoping you can get some insights. Lisa, we might have some practices. Some best practices. Yep. If you end up with questions as I go along, you guys, please put them in the chat. Tips and tricks. Yep. Great. Awesome. Great. Thank you guys very much for what you've got in the chat. Some best practices, just some basic knowledge. So hopefully we'll cover a lot of that. Let me share my screen. And
Caitlin, can you expand on what you mean by non-dues revenue best practices? Is that the for-profit that you're bringing into your association? I'll circle back when we get an answer. If we get an answer on that. That's going to be my assumption because a lot of associations will have a for-profit arm, as you know.
Yeah. All right. So I'm with Assured Strategy, and we help organizations focus on the areas in which they make the four main decisions to drive and scale growth. Those four being people, strategy, execution, and cash. And so what does that mean? So the people decision is about the harmonious culture of accountability. Do you have the right people in the right seats, doing the right things right? That will be our next session coming up later on this month. The strategy decision is about strong top-line revenue growth. Can you state your strategy simply, and is it driving sustainable growth? Are they coming to you, or are you trying to work very, very hard to get people to be your customers? The execution decision is about converting revenue efficiently and effectively into profit. Are all your processes running efficiently and effectively without drama and driving industry-leading profitability? And that's going to be our last session on April 7th. The cash decision, today's work, is about oxygen, having sufficient, perhaps abundant cash to have options and make wise decisions. So do you really have the cash to grow? Right? So there's a saying that we have: revenue is vanity, profit is sanity, cash is king. Right? The reason we say that is that a lot of people who run and own businesses like to talk about their revenue, and they can be, I'm $1 million, I'm $5 million, I'm $20 million, whatever it is. Whatever your revenue is may or may not mean you're profitable. But even if you're profitable, you can go bankrupt. And the reason for that is that profitability is about revenues minus expenses. That does not tell you if you have money in the bank to pay the bills when they come, right? And in a number of states, you can actually go bankrupt. There are laws, there's federal and state laws about meeting payroll. And if you can't make payroll, you can go bankrupt. If you can't pay your bills, you can go bankrupt. That's why cash is king, right? Because you can have an unprofitable year, but if you have the cash to pay your bills, you can still be in business. Finances are funny that way. Right. So just thinking about it, what makes the engine go? This is an airplane engine. What makes an engine go? If you want to just put in the cash, in the cash. If you want to put in the chat, what makes an engine go?
Fuel.
Fuel. Yeah. Gas. right? Gas. So what makes your business go? Cash. Cash is the fuel for your business, right? Cash is the fuel for your business. I know of people who have founded businesses that have put payroll on credit cards when they didn't have enough cash, that have taken equity loans on their homes so that they could pay payroll, that have taken out 401k money to pay payroll because they didn't have enough cash to actually keep their business open. So we want to talk about that today. And there's this triangle. There's a relationship between growth, profitability, and liquidity. Liquidity is code for cash and other things that you could quickly turn into cash, right? So liquidity is something that can be converted into cash in 90 days or less. When you're growing, if you're profitable, you should generate cash, which helps you grow, which helps you be profitable, which helps you generate cash. And it becomes this cycle. And if any one of these sides of the triangle is off, the triangle just sort of implodes, right? You need liquidity to fuel growth. You need growth, to have profitability. And a company cannot succeed without all three. So one of the things we talk about is the cash conversion cycle. Now, I will say in this slide always bugs me because personally, I want a cycle to be a circle. This is more like end to end. So the cash conversion cycle is about how quickly, what's the amount of time it goes from you've made a sale to you're collecting the cash from it. So if you think of it about like a football field, one goal line is where you make the sale, and the other end zone is where you get the cash, right? And you want to get down there as quickly as possible. And there are stops along the way. You have to make you may have production, you may have inventory, you have a delivery cycle, you'll have a billing and payment cycle, right? So these are typically the four elements of a cash conversion cycle. So I want to give you a couple of examples of companies and their cash conversion cycles. Dell is a great one. In 1991, when Dell was in business. Now remember Dell, they made computers. Remember in the 90s, that predates the internet for most of you. We just had email. For anybody who's been around, was in business at that time, we printed out our emails and filed them because we didn't believe that they would be still there if we went back on the computer the next day. I don't know what we were thinking. But Dell sold computers. And so you might remember in that time, you would go to a store like a Best Buy or a Radio Shack or another store, and you would walk in the store and you would look at computer models and you would pick the one you wanted. And then somebody would take this giant box on a rolly cart and help you get it to your car. In order to run their business that way, Dell had to order a bunch of parts, put the computers together. They had a certain number of types of computers. They'd box them up. They'd ship them to these stores would order inventory of these computers, and they'd have them in their back of the shop storerooms and warehouses. So it took Dell 63 days on average to get the money from for the time they purchased their inventory to the time they collected money on a sale. They had a 63-day cash conversion cycle. In that time, they hired a CFO named Tom Meredith, and he was hired to improve their cash conversion cycle. 63 days is more than 2 months. They wanted to make money on their spend faster than that. So within 10 years, he had changed their business model so that they were getting their sales money 21 days before they were spending the money themselves. So that seems impossible. How did he do that? Well, as you look at those dates, 1991 to 2001, the internet became a thing. And ordering on the internet became a thing. So what Tom Meredith saw the capability to do was, instead of just stocking the Best Buys and the Radio Shacks and the other places with a bunch of pre-made things, they could have a website where their customers could go on the website, choose what they wanted, give a credit card in advance, and then get delivery of the computer to their office or their home or wherever, right? That process of converting from that old style way of doing business to the internet way of doing business was an 84-day improvement in their cash conversion cycle. They get their money before they spend their money, right? And I say this so that when you think about your own cash conversion cycle, what opportunities do you have to get money faster, right? The next one we're going to look at is Costco. Costco had a couple of problems when they first started. They wanted to sell things directly to consumers, but they were a warehouse wholesaler, right? And in many places, in many states, it wasn't legal for wholesalers to sell directly to consumers at discounted prices. So they were trying to figure out, how do we sell to consumers at discounted prices while making a reasonable profit in the meantime. Well, I don't know about you, but I am a longtime happy Costco member of almost 24 years now. I became a Costco member when I was pregnant with twins because diapers. And so Costco came up with this membership concept. A number of you have essentially a membership type of model, right? Where people pay to be a part of your organization. Costco's membership fees make up only 2% of their revenue. However, membership fees make up more than 50% of their profits. Membership fees cover all of Costco's operating costs, so they can sell products to consumers at very discounted rates. And everybody's so happy about it that Costco has a more than 90% membership renewal rate annually. And I see, Kenneth, you're in Sam's Club, and they probably have a somewhat similar model. Not sure what, I haven't looked up, researched Sam's Clubs or there's another one up here. But Costco has a couple of competitors in this wholesaling space. And I don't know if they are as good as or better than Costco. Yes, Nisha, it was 2% of revenue, 50% of profit, covers 100% of their operating requirements, right? So they have already covered all of their operating costs through memberships before they sell any of their products. Really good business model from a cash conversion standpoint, right? One of the things that I'll send to you, I'll put it in the chat at the end, but we'll send it to you guys, and it'll be available for Nicole to make available to you guys later. This is a tool called the Cash Acceleration Cycle tool, and what this is it looks at the four aspects of the cash cycle: your sales cycle, your production inventory cycle, your delivery cycle, and your billing and payment cycle. And it's just a simple form that you can use to brainstorm in your organization, how can we improve each of these elements of our cash conversion cycle? What opportunities do we have to shorten the cycle time, eliminate mistakes, or alter or improve our business model? Anything you can do to shorten your cash conversion cycle is going to be helpful. Questions about that at all? Okay. So now the next thing I want to do is take you through the dollar bill story, because I want to give you an overview of what business financials look like. Because I find in working with hundreds of leaders across so many companies that the overwhelming majority don't really understand the financial statements of their company, and don't understand some of the language that gets used in talking about them. So I want to just do some level setting, and the dollar bill story is a great tool for that. So let's say this is our business. Our business, this is the income statement for the business. So there are 3 financial statements: an income statement, a balance sheet, and a cash flow statement. This is the income statement, also called a profit and loss statement or a P&L. You will hear those 3 terms used. They mean the same thing. Income statement, profit and loss, P&L, all mean the same thing. The profit and loss, the P&L, is a lot like your checking account in that money comes in, you spend some, and you want some left over at the end, right? So it's almost like a checking account in that way. It's very easy to understand. It's the financial statement that most people are most familiar with, right? So there's some terminology that we want to use with this financial statement. Now, an income statement covers a period of time, and the top of the income statement will say for the period of time ended and a date. It could be for the month ended, the quarter ended, or the year ended. Right? This one is the hypothetical year ended December 24th for this mythical company that has nice, easy round numbers because that's just easier math for me. I don't know about you. So it's a $10 million revenue company. So let's just look at what these elements are. So that's a line. There are a couple of lines associated with an income statement. Above the line is what we'll talk about first. Above the line are the elements that are directly related to revenue. So revenue is the first thing. And then right under that are the expenses associated with getting that revenue. Cost of goods sold. Typically direct labor and materials, right? And so you'll subtract from that. And so the most important thing in accounting is that when you categorize something one way, one year, you keep it in that category subsequently. If you change what category things are in, it makes your financial statements not comparable, and that's the government looks upon that with a frown. They want your financials to be apples to apples. So if you change how you categorize something, you have to go back and restate how you categorized it in prior years to create that apples to apples comparison. So it's not healthy practice. It does have to happen sometimes, but it's rare. So revenue minus cost of goods sold, COGS, which is made up of direct labor and materials, gives you your gross profit. In this case, $3.5 million. The gross profit also has another name, gross margin, and is often expressed as a percentage. It's as a percentage of revenue, also called sales. In some businesses, it could be bookings. In some cases, it could be booked revenue. How you recognize revenue is something that different industries have different standards, but basically that's what it means. Sales, revenue, the money coming in. So $3.5 million is 35% of 10 million. See, I love simple math, right? How do you know if that's good or not? You don't know, because in some industries, a 35% gross profit or gross margin is excellent. In other industries, it's terrible. How do you know? This is where Google or Chat or Claude come in super handy, because you put in, I have this kind of company. This is my rough size. What are the benchmarks in my industry at my size for these kinds of financial figures? And if it says, well, if you're a software company and you have a 35% gross margin, that's terrible, right? That's very low. Most software companies are very high. And if you think about why, it's because they pay the labor to make the software once. They sell that software over and over and over and over again without additional labor, right? But direct labor and materials is a lot more if you're a construction company. Why? Because you can't collect any revenue until you make stuff. You can't make stuff. You don't make stuff once and collect money on it over and over and over again. Every time you make stuff, you only get paid for the stuff you just made. And then you have to make another thing to get paid for that other thing. And so it's a much tighter company. It doesn't have nearly as much of a gross margin. Okay, so hopefully that makes sense. After that is below the line. Below the line are those expenses that are not direct labor associated expenses. They're indirect expenses or operating expenses. These are often these are often fixed costs. It'll be like the labor that's not involved in doing the work. So this could be your executives. This could be your office staff, right? The people who aren't doing the actual work are your indirect labor. The other thing you pay with operating expenses is rent or a mortgage, depending on whether you own the building, utilities, administrative costs for IT, for marketing, for office supplies, and insurance, and so forth and so on, right? Once you've paid your operating expenses, you get your EBITDA. EBITDA is a phrase that you'll hear a lot if you listen to the news or listen to podcasts or read the paper or anything like that. It's an acronym. It stands for earnings before interest, taxes, depreciation, and amortization. Interest, taxes, depreciation, and amortization. That's EBITDA. It's just an acronym. That's all it means. What it is the operating profit of the business. Because interest, taxes, depreciation, and amortization are financial expenses, but they're not operating expenses. You have to pay them, but they're not part of the making of the stuff and the performing of the labor. Right? So after you subtract, and EBITDA also will be used to value your company and get expressed as a percentage. When companies go for sale, you might have heard people talk about, they're getting this kind of multiple or that kind of multiple. They're getting 5x. 5x. What is 5x? We're in algebra. We're not in algebra. We are. 5x means that the value of the company, the EBITDA, multiplied by 5, is what somebody paid to buy a business. How do you know if your EBITDA is good or your operating profit is good? Google it, compare, get a benchmark for your size company in your industry, and you will see whether or not your numbers are good. You can also find out what are good multiples for your industry. All industries have a range of multiples. So let's say it's 5 to 8. That means that if it's a well-run company, it could get as much as 8 times EBITDA. Somebody would pay more for it. If it's a poorly run company, it might only get 5 times EBITDA. Somebody would only pay less for it because it's not as good a company, right? So that's what those numbers refer to. That's what those phrases refer to when you hear that. And then the last number, the bottom line is the last number, is your net profit or loss, right? So these are common business terms. Does this make sense at a very basic level? Great. Okay. Now, what you will see if you look at your own stuff is that there's a lot more lines. Yes, because there's a lot of detail, but when you fold all that up, these are the main categories of an income statement for any business. Okay, great. Thank you for those of you who replied that it's making sense. And I'm sorry for those of you who are financial experts, but I like to really simplify it. So now let's look at what this means. So one of the things that people often think about is if their company is a $10 million company or a $100 million company or a $1 billion company, whatever it is, employees often think that somehow means that the owners of the company have $10 million. Well, they don't. So let's assume that 100% of the revenue of a company is represented by this dollar bill. The 100 cents of the dollar bill equals 100% of the revenue of the company. Okay? So how much of that goes to direct labor? That much goes to direct labor. That much goes to materials. That's our gross margin after that. Then we get our indirect labor. Remember, that's our operating expenses below the line now. Indirect labor, facilities, rent, utilities, some of our other admin costs, our IT, our marketing, our office supplies, and so forth. Then we pay our taxes. And you see this teeny tiny little sliver here on the lower right corner of the dollar bill? That's our net profit that we can bank. Right? That is a teeny tiny fraction of the overall revenue of the company. And so that's that bottom line, 5%. They're getting 5 cents for every dollar. Right? That's not great. Most businesses like to run at minimum of 10% as a net profit number. If you are a nonprofit, that's very different. If you are a nonprofit, it will be called a surplus, sometimes not a profit, and your net surplus will probably run low at like 2 to 3%. A lot of nonprofits run a very low net surplus. And that's because they put everything they possibly can back into the nonprofit to accomplish the mission of the organization. Now, not surprisingly, a lot of owners will reinvest their profits as well back into the business, but that's not necessarily what they do with it. But that's neither here nor there. So, yeah, right? Kenneth is saying when he worked for AT&T, he reviewed their quarterly earnings and used to think, wow, they made $40 billion and operating expenses were 10% of that. Yep. Those big companies, it's just a lot more zeros, right? It's just a lot more zeros. So you kind of can't let the zeros overwhelm you if you're looking at things. That's why percentages can be very helpful, because percentages takes away the size of the number and it makes it more comparable within its industry. Right. So what I want to do is then look at the basics of the 3 financial statements. The 3 financial statements are the balance sheet, the income statement, and the cash flow statement. Interestingly, the income statement is the only one that gets all these other names, a profit and loss or P&L. A balance sheet's a balance sheet, cash flow statement's a cash flow statement. You'd be surprised, well, you might not be. It always surprises me, although it shouldn't because it happens most of the time, that the overwhelming majority of the organizations that I work with do not look at the balance sheet and do not even prepare, or never mind look at, their cash flow statement. Even though cash is king and they can go out of business if they don't have enough of it. The exception to that is generally construction type businesses or construction adjacent businesses. They often look at their balance sheet because they have to get bonding, which is insurance for their projects, and that relies on some balance sheet items. So the balance sheet is the value of different assets and liabilities. Assets, stuff you have, liabilities, stuff you owe. The balance sheet is the value of these different assets and liabilities on a particular day. The next day, that value could change. The income statement, remember, is a period of time. The cash flow statement is the same period of time as the income statement. And the date that the income statement and the cash flow statement have on it, that's the date of the balance sheet that they're working with. Okay? So if it's an end of the year income statement, it'll say for the year ending 12/31/24. Cash flow statement will say for the year ending 12/31/24. Balance sheet date will be 12/31/24. Right? They all go together. And so let's see how some of this works. So looking just quickly at the balance sheet, you see there are things that are called current assets. Current assets are short-term assets, assets that can be converted more quickly into cash. Cash is the most liquid because it's cash. AR stands for accounts receivable, and inventory is inventory, the stuff you have that you're going to either use to make stuff or sell. Those are called current assets. Fixed assets can include equipment, sort of long-term pieces of equipment, cars, that type of stuff, buildings. Liabilities similarly are divided into current and long-term. Current AP is accounts payable, so you have accounts receivable, people owe you money, you have accounts payable, money you owe your vendors. Taxes, current liabilities, and then long-term liabilities are long-term debt. So if you have a loan, a mortgage, stuff like that. And then there's equity. Equity is what's the value for the shareholders of the organization, right? That's their equity. And the balance sheet has to balance. What does that mean? That means that the total assets has to equal the sum of the total liabilities plus the equity. And in this balance sheet, you see that they do. Where do those things show up on the income statement? They don't. They don't. That's why you have two statements. Is all this stuff important? Is how much cash you have important? Absolutely. Is how much people owe you important? Absolutely. Is how much you've got in inventory important? Absolutely. You can't run your business without knowing that, right? All of these things in this balance sheet are really important numbers. They don't show up on the income statement at all, and yet most people don't look at the balance sheet. The cash flow statement, when you look over at that, our profit, goes into, we've got cash, we're spending some cash, we've got some change in values. So we've got cash from operations, cash from investments, cash from financing. So we have a beginning cash balance, a change in the cash, and an ending cash balance. So the cash flow statement is going to show what cash is coming in, what cash is going out in that period of time in each category. It's addition and subtraction, right? That's what I love about the financial statements. It's addition and subtraction, and then a little bit of percentages thrown in if you're doing any analysis. Okay, so let's look at what this means for a transaction. Right. So if I'm doing the income for the year begins with the balance sheet that ended the previous year and ends with the balance sheet that ends the same year as the income statement. So if this is 12/31/24 for the income statement and the cash flow statement and the balance sheet, then the beginning balance sheet is 12/31/23, because the year of 2024 starts where the 2023 ended. So I'm just going to do one of these, the cash one. So we ended 2023, we started 2024 with $50,000 in cash. We don't see cash on the income statement, but we do see it on the cash flow statement, right? So what happened to our cash? Right? We started with $50,000. We got $180,000 in accounts receivable, but we collected revenue of $210,000, right? So, hang on. Our revenue is $210,000. So to that 180, we added $210,000 of accounts receivable, but we collected only 200, right? So that means that we collected only 200 of the 210 plus the 180. So what's left over is 190. You see the accounts receivable? The cash, we started with 50,000. We spent 77,000. Sorry, we spent 27,000. We ended up with 23,000, right? We started with 180,000 in revenue in accounts receivable. We sold 210,000. We only collected 200, so we end with 190,000 in accounts receivable. May not be the same 190,000, like you've collected some of the 180,000 and some of the 210. So the accounts receivable is going to be made up of different people who owe you, but it's going to total to 190. Does that make sense? Right? And so you can do that across all of these arrows, across all of these statements, to follow the flow of what happened in that business that year for these categories. 'Okay? So the next thing I want to talk to you about is what's called the power of one. Now, the power of one is looking at there are 7 levers of cash in your business. Sorry, would you track which, monthly or daily, Kenneth? Kenneth just asked, would you track these monthly or daily? Would you track which, Kenneth? The previous slide. So a company is tracking all of these things every day. Every day there are transactions that a company is tracking. They don't prepare financial statements every day. Financial statements are typically prepared monthly, quarterly, and annually. But the transactions that form them are tracked every single day. So companies will have a software system. Typically, in small companies, it might be QuickBooks. So if your companies are very small, that might be QuickBooks. Could be NetSuite. There's a number of different accounting software packages, and it's set up so that everything you sell that day gets tracked in the system. Every dollar that comes in that day gets tracked in the system. Every piece of inventory that gets used that day gets tracked in the system, right? So all of these things get tracked daily. They get totaled monthly, quarterly, or annually for the financial statements. But a lot of companies will look at some of those numbers on an hourly, a daily, or a weekly basis, right? So a lot of companies will track sales every week, right? Or they might track inventory every day. Right. So they might track certain things and look at them more often, but these particular statements are done more at regular intervals. Okay, so the power of one is about looking at the impact of changing any of these levers of cash on your cash flow. So for those, and this is a tool that you will get in a handout as well. What you want to look at in the power of one, and this is software. With Assured Strategy, we have a software system that we run this for all of our clients, and we allow them to do scenario planning. So we'll put in their actual numbers and then look at what if we changed our price. So you put in your current position of net cash flow and operating profit. And then we look at the impact of that. What if we increased the price by 1%, or the volume by 1%, or the cost of goods? What if we reduced our cost of goods by 1%? What if we reduced our overhead by 1%? What if we reduced the amount of time it takes to collect our receivables? What if we reduced the amount of inventory we hold? What if we increased the amount of time we take to pay off our bills? Okay. All of these are the 7 levers of cash. The top 4 appear on the income statement. The bottom 3 are associated with the balance sheet. Debtor days is your accounts receivable. Stock is your inventory. Creditor days is your accounts payable. Okay. What you will find if you do this for your business is that by far, the biggest impact you can have on improving your cash flow is an increase in price. By far. It can take 4 or 5 times as much. If you increase your price by 1%, it can take 3 to 5 times as much volume to sell to make up that cash flow. Right? So you want to, salespeople often want to offer discounts. You want to be very, very careful whenever you offer a discount to use this sheet and to look at this information to calculate what is the impact of a price discount. How much volume do we have to sell to make up for that lack of cash coming in based on price? Right? It's a trade-off. It doesn't mean you never do it. If you have aging inventory, or you might offer discounts. If you have stuff that has a shelf life, you might offer discounts. You might offer volume discounts. You might offer discounts for if you're short on cash, or if your cash conversion cycle is very long. you might offer some of your customers a discount to pay faster. But you have to know what the cash impact of these discounts is going to be. You have to. And if your financial people aren't able to calculate that for you, and you have an accountant who helps you with your taxes, talk to that accountant and get them to help you with this. You must know the impact. Yeah, if you're not raising dues for 15 years, you are 15 years behind on cost rate, because cost of living has increased every year of those 15 years. Nisha, am I saying it right? I don't know if I'm pronouncing it. N-E-I-S-H-A. Is that Nisha? Nisha? Anyway, Nisha. Nisha, thank you. That means you're 15 years behind the increase in what it costs you to do business. It's generally good business practice to have a steady rate change on a regular basis that your customers just know is baked in. A lot of businesses that I work with that have inventory right now have been hit hard by the tariffs and have had to build that into their prices. Yeah, first time in 10 years. So Jane Scott and I both run Vistage peer groups, and we bake in a 3% increase in our membership rates every October. We have a fiscal year that starts October 1st. So every year we have a 3% pricing membership dues increase every year. Good years, bad years, 3% increase across the board, right? So if you're going to change any of these things, please work with a financial person who can help you calculate this information. It's incredibly helpful, and you can run scenarios. You can. This is like the what if. What if we were able to do this? What if we were able to reduce our cost of goods sold? What reduces cost of goods sold? Right? Cost of goods sold is about how efficiently and effectively you run your production, right? How effective are your people who are doing the work? Sorry. Right? So we want to look for waste, and this is another tool you're going to get. We want to look for where might we have waste in the system, right? Any waste in the system costs you profits and costs you cash, right? So cost of goods sold is affected by your production capabilities. How efficiently and effectively are you producing? The more efficiently and effectively you can produce, the lower your cost of goods sold is going to be. The more efficiently and effectively you can deliver your services, the lower your cost of goods sold is going to be. Cost of goods sold is the second most effective way of getting cash in your business other than price, right? Okay. So what you see here is this is about figuring out, you can use this typical waste that drain cash flow and erode profitability to look at where you have operational inefficiencies. How do you track it? How do you monitor it? What might you do to improve? And interestingly, you see the one right in the middle there, right person, right seat. The underutilization of talent is really costly. And we all know this, sort of intuitively, right? If we have somebody who's not doing a very good job, we know that that's not good for the business. We don't necessarily do as good a job at understanding really what is the financial impact of somebody not doing a very good job. There is also a financial impact for turnover, right? It's huge. So hiring effectively, training people effectively, supporting them in their role, the right people in the right seat doing the right things right is essential to profitability and cash flow.
And it's the topic of Tuesday's presentation on people.
So coming up.
Because this cost actually will infuse itself, right? It's not just the cost of doing the rework or the cost of delay in delivery. It's also who else is doing somebody else's job, right? So it really is insidious. Thanks for calling that out.
Yep.
Come on Tuesday, people.
Come on Tuesday, learn more. Woohoo! Okay. So with these typical ways. So what I want to do is just quickly give you 10 things that might improve your cash flow if you're running cash tight. Now, if you're running cash tight and the tariffs had some businesses running cash tight, some people have adapted to the tariff situation. Now you might have cost of fuel running your business cash tight because fuel prices are increasing. And if you're in agriculture, fertilizer prices are increasing dramatically because of the situation with the Strait of Hormuz in Iran, right? So 10 things to quickly improve cash. If you need cash quickly and you don't want to put debt on your credit card on behalf of your company or take out an equity loan on your house, right? If you lease but don't buy things, that can improve cash. If you offer discounts for early payment, now again, you do have to work through the impact of the cost to your cash of discounts. If you need more cash now and can sacrifice, if you need less cash now and can sacrifice it for more cash later, that's a trade-off that you're making. Discounts is less cash, but I get it faster versus more cash, but I get it later. Do you check your customer's credit? Are they good for it? Get your invoices done as soon as possible. That invoicing process, be shocked how many small businesses don't get their invoices out in a timely manner. No, nobody's paying you without those invoices. Check with your suppliers. What kinds of discounts do they offer, right? Using credit cards and ACH transactions, banking transactions, to get paid is a very simple way to automate things, right? So back in the day with organizations used to get checks, used to get cash. Even if you're a retail organization and you take in cash, cash has to be collected, counted, taken physically to a bank, and deposited. That takes more time. Credit cards and ACH transactions are immediate. And remember our cash flow, our cash conversion cycle example of Dell? They got credit cards payments up front before they did the work, right? Great way to get paid in advance. Call your accounts receivables people. So if you do not have an accounts receivable clerk, but you have outstanding receivables, somebody needs to get on the phone and call those people. Accounts receivables clerks are an unusual breed. If you have a good one, cling to them, because most people don't like calling other people and asking for them to pay. Most people don't want to call other people and ask for money, even though they owe you, right? Even though you've done the business, you've done the service, they've gotten the thing, they owe you. A good accounts receivable clerk is not normal, because they want to make those calls, because they are incensed, they're indignant that how dare they not pay when you did the business? How dare they? They owe you. So they feel it's like a moral obligation to get that money in for the business. Good accounts receivable clerks are gold, right? So get one of those. Clean up your inventory. If you have aging inventory, can you get it off the books? Can you sell it? Even if you're selling it at a discount, you want to get that aged inventory taken care of. You want to clean up your inventory. Also, look at your vendors and suppliers. So accounts payable clerks are also worth their weight in gold, because here's your normal accounts payable person. Your normal person gets a bill and wants to pay the bill, like right away. Like they get the bill, they want to pay it. You have terms with your vendors. It could be that the bill's not due for 30 days. Why do you give them the cash any sooner than you have to? You need your cash. Hang on to your cash. Don't pay your cash out any sooner than you have to. A good accounts payable clerk is going to be comfortable with what's called stretching the payables, not paying any sooner than you have to, unless you are getting a deal and that deal is worth it. If you're getting a discount for early payment and the cash flow analysis shows that the deal is worth it, then you pay it early. right? Also, if it's a critical vendor and you really depend on them and you want to maintain a good relationship with them, you don't want to stretch them too far. You want to make sure you're paying them on time. Some vendors you can stretch beyond their terms. States do it all the time. There is not a single state or the federal government that pays anything on time. Anything. They pay in the same fiscal year, but they do not pay on time. It can take 6 to 9 months to get money from the state or the federal government well after you've done the work. And you are essentially loaning that state or that government or that person your cash until they pay you for the work you've done, right? If you're stretching your vendors and suppliers, they are lending you their cash until you pay them, right? So you can think of it as turnabout's fair play, but it's about cash management. I know there were a couple of you who wanted to think about cash management. Looking at your vendors and suppliers relationships and terms is important, and getting those receivables taken care of is important. If you have a lot of cash on your balance sheet that you don't use daily, you want that cash being moved into some sort of financial instrument that will earn interest. You don't want cash just sitting in a bank account. It's like sticking it under a mattress. It's not doing anything for you. If you have excess cash, good for you. Have it earn income for you, right? So talk to your banker about that. If you don't have a banker, you have a banker. You just may not have a relationship with that banker. Talk to the business banker at your bank. And if you have extra cash, you want to talk about how you can have that cash earned for you. Maybe it's putting it in an interest-bearing account of some sort. Those all have terms. So you have to look at how much cash might you need access to quickly versus more slowly, based on, and the longer you put your cash, the longer the term, the higher the interest rate. So something you can take out quickly is going to have a lower interest rate. Something that you take out over a longer period of time is going to have a higher interest rate. But that's part of cash management. Really, really big companies will do overnight deposits of millions of dollars into bank accounts that will earn interest in hours, and they'll send it out at night, they'll pull it back in the morning, and they have these overnight accounts that earn interests in hours on cash. But that's really, really big companies, big banks. The other thing to do, look at your pricing. Right? If you haven't raised prices in a long time, you're behind. You may not be able to raise it up to market rates all in one fell swoop because that could shock your customers. But if you can, great. And then get a steady flow of increasing pricing every year. It's just normal, healthy business practice. Your costs go up, your prices have to go up. All right, so tools that we looked at today, the cash acceleration cycle, the power of one, and typical wastes. All these tools will be available to you. So following up, in the chat, tell me about some action you could take from today or some value that you take from today. Not all at once. Vanessa, thank you. Understanding how to read financial statements. Looking beyond just the revenue, Nisha, thanks. Yes, Ava, don't be afraid to increase member dues. Looking at your current fees and where can you potentially increase them? Yes. Looking at our financials side to side. More detailed discussions. Yes. Yep. Oh, great. Yeah, thank you. More frequent discussions about necessary changes. There is a lot operationally that you guys can do to improve the financials of a company, and the tools get to that. Thank you, Nisha. Yes, get those outstanding dues. Yes. Thanks, Pam. Yes. Don't pay the bills the second you get them in. It makes normal people very uncomfortable. But a good payables clerk will be down with it. Yep, balance sheet discussion. Anybody have any questions that I could possibly answer in the next 2 minutes? Yes, when I said shorten the cash cycle, Kenneth, that was the cash conversion cycle. That's shortening the time it takes to get the money from the time you deliver, from the time you make the sale, right? So if your sales cycle is long, but you can sell faster. If it takes you a long time to deliver, but you can deliver faster and more efficiently. If your invoicing takes you too long, can you improve your invoicing? If your delivery takes too so there's the 4 different areas, and there's the one tool that I'll provide to you guys to help you to shorten that cash conversion cycle. Oh, glad, Diana. Thank you. I made accounting fun. Woohoo! It is fun. Thank you, Elizabeth. And a reminder that we have 2 more sessions coming up with Jane Scott on people, working in perfect harmony and being relentless. Remember, we talked about people, right? People in the right seats, doing the right things right. Oh, thank you, Kenneth. And the last one, execution. You can't scale chaos, right? So I'm just going to stop my screen share and put the tools in the chat so that you have those. And then
we can turn it back to Nicole, who's got a wrap up for the last minute.
All right. So the 3 tools I talked about are now in the chat. You can download them. Right. And if you have any questions for me, or you want to follow up, if I can help you or your organizations at all, I am more than happy to. This is what I do. So I'd love to meet you and love to hear from you.
All right. Thank you so much, Michelle. And your final question there really overlapped with our usual final question, so I'm going to call that good. Just make sure for credits that you've put into the chat an action item or your most important takeaway from today's session. And I've dropped links in there for the 2 upcoming sessions, as well as the recording of the past sessions, so you can check out this whole series. Thank you again, Michelle, and thank you to all of you for being here. We'll see you next time. Have a great rest of your day, everybody.
Thanks, everybody. Great to see you. Well, sort of. Great to work with you.